All right, let's give it a couple seconds here for everybody to come in. Hello, everybody, and welcome to our webinar, Advanced Strategies for Financial Planning and Management. Thank you for joining us today. My name is Alex Martin, KWPMC partner, and I'm delighted to be here with you. I am joined here by our expert panelists for today's webinar, but before we dive into the discussions, into this session, let's go over a few housekeeping items. The session will last approximately about an hour. We'll have a Q&A. The Q&A is open. Use the Q&A chat open for all your questions. Feel free to submit your questions at any time using that chat feature, and we'll do our best to address them. It is also very, very important to share that the information provided throughout this webinar and subsequent recordings is intended for informational purposes only, should not be taken as professional accounting advice. We recommend that anything you learned today to please discuss with your professionals, your attorney and accounting professionals, as every association is unique. So our goal is to provide you with information focused on advanced strategies for financial planning and management. So joining us today, we have the one and only Gabe Mendoza from Sokol & Sokol, and our very own Roxana Dorigo, Executive Vice President for KWPMC in Finance. All right, Gabe, let's start with you. Thanks for joining us. Can you share a little bit about yourself?
Yes, hello, and thank you all for joining. First and foremost, I'd like to say I'm a proud father of two boys, Eli and Jordan, and I'm a CPA that specializes in condominiums and HOAs. Born and raised in Miami, Florida, graduated from FIU with my master's in accounting, started my career at Grant Thornton, jumped over to condominiums and HOAs, and currently I'm a partner here at Sokol & Sokol, where we provide attestation services, so that's audits, reviews, compilations, and tax services to over 350 associations around the state. And I'm currently serving as the chair of the FICPA CIRA committee, which is a committee that governs the relationship between the practitioners in the state and the DBPR and the legislative branch of government, coordinating any and all the changes in the law, how it affects practitioners, boards, etc., kind of serving that need in the condominium HOA space.
Amazing, Gabe. Roxana?
Roxana Dorigo, Executive VP of Finance with KW, and I'm a boy mom. So I have a little boy who loves music, something a little foreign to me, but keeps me on my toes and young. And I started my career similar to Gabe. I was an auditor at one point with KPMG for many, many years ago. I joined KW 17 years ago this summer, and been really helping and navigating what's been happening in our industry. I do consult with clients. I help the on-site team here in accounting with the new legislature changes in accounting, and I've worked with Gabe, so I appreciate you're on this panel today.
Gabe, Roxana, I really appreciate both carving some time today to chat with us. So to kick things off, why don't we begin with a poll question. Have you had SIR study done, and is it already incorporated into your budget? And as we wait here,
we won't report anybody.
No, we won't let anybody know.
This is a really interesting question, though, because I know from our book of business and in our portfolio of condominiums, each condominium has become even more unique because of SIRS. Some obtained SIRS early in the whole process, so they were really proactive. Before even the statute clarified, right? Like there were certain things that were a little vague, they didn't understand, but they yet got a SIRS. So now having a little bit more clarity to some terms has made a difference. And then there's others that did not get their SIRS. So now looking at this area of reserves, especially now during budget season, is very particular. You can't assume, you can't look at something from last year because things have changed even from last year. It's changing month to month. So that's be interesting to know of those online, how many do have a SERS already in hand.
Do we have the results here? Here we go.
Great.
Yeah,
For
good
those
point,
that-
Roxana.
Yeah, go.
I was gonna say our portfolio, we do a large portion of condominiums in Southeast Florida. And we did see a lot get ahead of this early, which was nice. And then even clarify further. They almost did it as a test round. They got that first SIR study, and the newer buildings or buildings that wanted to get ahead, we're trying to just map out what was gonna be the financial impact. Because some buildings have been putting away reserves or doing the maintenance they needed to do, and found out that there wasn't much of a difference, that the reserves they needed were going to be there. And then others were, I wouldn't say caught by surprise, but we were able to plan. So getting involved early was a really good insight for them. So I'd say this actually is pretty representative of our population as well, with respect to having one and then getting it in place.
Yeah, I
So-
hope those that, I'm sorry, that said no, are boards of HOAs. Because those that said no and are condominiums and trying to get one now is a little difficult, most likely, before the end of the year when compliance is key for all condos.
Yeah, so here are the results, which is pretty interesting, right? Have you had your SIR study done? 71% said yes, 22% no. That seems like a high number. 22% still, right? And 7% is unsure. And is the study incorporated into your budget? 64% said yes, 36% said no. What kind of advice can you give to the individuals that haven't done their STIRs and haven't incorporated into their budget?
Well, first, if they're condominiums, right, that's really
condos, yes.
the group that would be affected by the SIRS. There's been a little bit of clarity, right, or change as of July 1st. If there was a milestone inspection within the last 2 years, if I'm not mistaken, you know, they do have a little bit of a grace period and a little bit of let me recover from that, because typically milestone inspections may have some areas that they need to fix. So they've been encumbered with projects, most likely. So now the statute recognized that and has allowed them some time to still be compliant with SIRS. For everyone else that's under the condominium statute 718, SIRS is a requirement by the end of this year. However, if for those that have been following the statute since it was issued, the compliance period was 2024, if I'm not mistaken, right?
Mhm.
So that's where the disconnect in all of our condos came, that some do have it, some don't have it, etc. So for those that don't have the SIRS, what do you do now? But you need to be a 718 condo. You do need to get the SIRS done as quickly as possible. There may be some engineering firms and or reserve study specialist firms that have availability. So I would recommend contacting your professional immediately. This is not a calculation that should be done by the board or your management team or accountant for that matter. It has to be done as statute has laid out the requirement, done by a firm that has a licensed engineer or architect. So you do need that from that type of firm. It's also to protect the board, protect the association that you are getting it from a licensed professional. And the statute also says that reserve study needs to be made available to all owners. So the biggest recommendation that I've been doing at on average once a day is that we need to have it available, and that reserve contribution that you're putting on your budget should be on that study. There should be no modification. if there needs to be a modification to your reserve contribution, because the board understood that there's something different or wrong with the study, it's okay to go back to the specialist and make sure that that reserve contribution you're going to put into 2026 is on that study. I'm being adamant about that to make sure that we have that as the report that we point to.
That's a good
Dave, what are
jumping
you seeing
point.
on your end?
Oh, I was gonna say, those that don't have it in their budget, the question wasn't really specific, 25 or 26, right? So you did have the ability to not budget for it in 26, right? I'm sorry, in 25, but they will be effective now in 26. So that's a good point that Roxanne is bringing up. On our end, and any condo really that's been getting an audit should have had some discussion with a CPA, because this was a hot topic prior years. You might have a communication letter that was sent to you if you're in the group that did not get a SIRS, to have that conducted. Your footnotes need to, by our standards, show the unit owners or readers how reserves are being funded. What is the board using to determine that number of funding? Is it a management study? Is it an independent study? So for those that are unsure, that's a great place to start. If you look at your financial statements, you might be able to see a footnote. The supplemental disclosure should have some language of where those reserve amounts are coming from and if a study has been conducted. So on our end, we are doing exactly what Roxanne is doing. Our firm, we are obtaining those reserve studies. We are ensuring that those reserve studies actually represent the starting point of where they should. One area is that you may have a reserve study, but the reserve specialist wasn't aware of the actual balance that you had in reserves. That starting balance is critical. So not only do you have the reserve study, but are the facts and circumstances in line with your financial position that the reserve specialist is utilizing to determine the calculation. So yeah, that's what we're seeing. We're seeing that right now, for sure, in budget season 2025 going into 26 is when you're going to take a fresh look at whatever data you do have and are using, and getting sure you're getting involved with your management company or your CPA to be sure that that 26 budget is going to be in line with that study that you've received.
Perfect. Can you explain what SIRS is? We got a lot of new attendees here, and questions are coming out. What is SIRS?
Great. So, Roxana, go ahead.
Yeah, a structural integrity reserve study. We just all been saying SIRS for short. We love acronyms. So when that came out, we all use it. Basically, it identifies key components that are essential to the structure of a condominium. So roof is one of those components. Foundation walls are one of those components, at least the ones that I've ever reviewed prior to the statute. I've never seen that on a statute, on a reserve study, but it defined it as part of structural component. Waterproofing and painting, exterior painting and waterproofing. Windows, there's a question mark there depending on whether or not the association's responsible for the windows. And there's a few other very specific components identified as structural. So basically the statute made a distinction between structural components and non-structural components. The structural components, some of those were already in just the regular reserve components, but basically what this statute's doing is making a separation. So if you ever look at a budget or an audit moving forward, you're going to have that distinction. There's going to be a reserve contribution for structural components and a reserve contribution for non-structural components.
And then the critical distinction on top of that will be the budget impact. You must fund that structural integrity reserve study amount, the structural portion, and then you may fund the other components based upon a membership vote to waive or not waive those reserves. And I'm sure we can get into that because that's going to be another hot question, right? SIRS reserves or structural integrity reserves, these items are no longer able to be waived. They must be funded. And then the other components will now require a membership vote, not a majority vote, to waive the funding.
Great. Thank you, Gabe. You know what? I'm curious to find out how many properties and how many individuals started their budget process. Can we take a poll?
This
Because
is
this
the
is a real
season.
important question here.
So our
Yeah.
recommendation of when to start a budget is on or around June. And I know that sounds very early. And in fact, let me even take it back a little bit. Your budget, the existing one, is a stepping stone to 2026 and any future year. So it really does start with day one of the year. So looking at your budget as living, breathing item that can give you a stepping stone to the next year's budget is really the way to address it. But from a process point of view, we start in June. And we do that because we know that we have about 5 to 6 months worth of activity already for the current budget time frame. And we know where we need to adjust potentially for the end of the year and into the following year. And the process is lengthy. We're talking about just one section. Right now, we've spent 16 minutes just talking about one item, potentially 2 items on a budget. And it's getting a little bit more difficult to navigate. So you do need your professionals. You need your attorney, you need your reserve study specialist, and you need your accountant. And in order to really understand where you are in the process of reserves alone, that takes time. I can tell you from my experience, just this year, as I mentioned, our condos are no longer all even. They don't all have a SIRS, or they needed an update to their SIRS. So it is an individual task that we're doing and really questioning where we are with that compliance. Where's the study? Do we need to update the study? Because some did obtain early studies, and the distinction in the split between structural and non-structural was not done. So we need to go back to the reserve study specialist to update the study, and that takes time. So it's all in the interest of getting the best information to do the best for the association and to guide the board. And that just takes time. So we do a lot of the work up front from between June and September. And then in September, we start supplying the draft. So the reserve is one area. Contracts, that's another area, another recommendation to start as soon as June with your budgets.
Thanks, Roxanne. Gabe, I'm going to you next here, but so 93% have started the budget process, which is great to hear. 2% no, that's no bueno, and then 6% unsure. Thoughts, Gabe?
Yeah, no, it's great. That's a big majority that's starting. Those are prudent boards that are taking a hard look, and I'm sure it's related to this SIRS topic, right? There's now statutory guidance. So if you're unsure, what we keep saying SIRS, and Roxanne listed a bunch. The statute's very clear inside, what elements they are in 718, paragraph G. If you go ahead down into the statute, they're listed there. And your engineers are well aware. These reputable engineering firms are going to split out your structural elements, those that affect the structural integrity of the building and those that don't. So that's not an accountant's call. That's not a management's call. That's not your lawyer. That is that engineer. We're gonna take them for what they do. We're not going to be the ones to make those calls, but that's where that delineation comes. And as far as the operating side of the house, you've always got to take into consideration that you're still running an association. Again, on top of SIRS, how is your operations going? So one thing that we take a look with our clients with budget season is your operating fund balance, right? That's a concept that it's a little foreign. If you run a business, that's what retained earnings is, your accumulated profit or loss, right? From inception. And taking a look to see, a lot of condominiums say, what can we do with it? Well, if you have some earnings, our recommendation is 2 to 3 months of working capital. That's like a rainy day fund. Insurance rates may be going up, may not. You might have a leak, something that covers your working capital in case of emergency. But then revisiting your actuals, either from take a look at your audits. Those are adjusted numbers. That accounts for all the activity that you performed in the prior year, to be sure you're not looking at outdated data and you're looking at, okay, the water bill was X, the electricity is Y. Those really don't change over time. But to Roxana's point, your contracts, are you undergoing any special projects? Did you do something last year you budgeted for that you don't need to this year? So don't just roll the budget. It is a truly working exercise. It should be something that's visited over and over again to be sure you're dotting your I's and crossing your T's, because there might just be something that sticks out, and you find that you've been just rolling from year over year, that isn't necessary. Or maybe something you missed, like, oh, we were going to do a landscaping project this year and we totally forgot to budget about it. So it's just something that should constantly be talked about. And Roxana is saying every month you're getting a budget to actual variance and making that note of, hey, we're constantly over in legal fees, but it's not, everyone says, well, next year will be better. Next year will be better. But being cognizant of the reality of expenses.
So I got a lot of questions here, and they keep asking online, can you list the items required for SIRS that are required to be fully funded over time? Like off the top of your hand, what are you seeing out there? What is it?
For
what
sure,
are the requirements?
Okay. Yeah, roofs,
Mhm.
structural systems, fireproofing, plumbing, electrical systems, waterproofing, exterior windows and doors, and then here's the kicker: any other item with deferred maintenance or replacement costs exceeding $25,000 that affect the structural integrity. So it may not be listed directly, but there may be a component of your building that the reserve specialist walks the property and says, oh, that component can impact the structural integrity of your condominium and should be included. So that's where those are the items.
Like a pool deck could
Right.
affect the structure depending on the positioning of the pool deck. So that would be something that some may have as non-structural just because it is not part of the structure, where others, it may be a structural component. But again, just pointing to the specialist, we do want that to come from that definition and what is included as structural from the specialist, the engineer, basically.
Great. Julie's asking, is there a website that she can go to find these items?
I think the best place is just to go ahead and Google Florida Statute 718. Go ahead and hit the button. It says view full chapter, and you can search in that chapter to see structural integrity components, and you will hit the jackpot there.
Okay, wonderful. All right, so let's talk about reserves. There's a lot of questions coming out here about reserves. Every how long should you be doing a reserve study for your association?
I could take that first. We recommend an update every year, and every 3 years a full study. So the recommendation comes from this. There's inflation. There are changes depending on where you live in Florida that are constant. Like when you see the cranes on downtown Miami, you know the developers are in town, and that drives cost, demand driving costs. So we like our clients to include in the engagement with the reserve study specialist as a recommendation that they get already negotiated in the contract updates every year. And it's only updates to numbers. They're not coming on site. They're just updating what, from a market perspective, how are the costs adjustment? What are the cost adjustments? So that negotiation at the beginning may maybe some cost savings to the association because you're guaranteeing work for the specialist up front, and then every 3 years a full study. And that's both for SIRS and non-SIRS, so structural and non-structural. It's the same recommendation. The statute does not have a provision or a recommendation of that. That's more recommendation that would come from us, like from your management company, your attorney, or your specialist.
The statute does say at least every 10 years, but I will say to Roxana's point, when we see clients that have outdated studies, and I say outdated more than 3 years old, we raise the flag to our clients as well. It's not, you know, a gap finding. It's not something that's going to come out on your financial statements. It's kind of like a, hey, you know, it's time, given inflation, given cost of construction. I mean, ever since, you know, the construction environment's gone a little crazy, you know, these projects that were quoted, you know, $1 million can now be 3 million. So there's that component. The other component is the association may be doing some projects that are not necessarily reserve items, but let's say a beautification project at the pool that happens to add some life to the pool deck. And the reserves, you kind of want that reserve specialist to be aware of these things so they can update their useful life. It wasn't necessarily a planned elevator remodernization, but let's say we had a water leak and had to redo the tension cables. That may now, those tension cables are now fixed this year, not 5 years from now. So it's prudent to always be pinging your reserve specialist and get into these programs they're now offering with these annual updates to be sure that your reserves study is really in line with how your building has been maintained. So anytime we see a big special project or maybe, you know, an insurance event that may affect a structural component, kind of want to let the client know, hey, take another look with that reserve specialist and let's see if it affects the potential funding for that component.
Yeah, that's a great point, that it's also driven by basically the reserve studies are built based on assumptions, not reality. And sometimes what we see is that a condominium has to do the exterior paint at the same time as the roof. How likely is that going to happen? Probably not in the same year. So to your point, there may be things that are outside of the estimated time of replacement because of need, because something broke, and then they decided out of the interest of the cost, we're just going to replace the whole roof. There's no point of just patching up the roof. If we have to replace it in 5 years, they might accelerate it. So that assumption changed, and it may materially affect your reserve contribution. So another great point as to why an update every year is warranted. Yeah.
And I want to play off that a little bit because I just saw in the chat this concept of fully funded. How much money are they going to ask me to put up on this time I get this study? And it's a calculation such that the funds will be available when or if that component is going to be replaced. So if a component would to cost $100,000 in 10 years, by a straight line method, you could put away $10,000 for the next 10 years to have that $100,000 in year 10. The $100,000 does not have to come day one. So that's another element that boards kind of need to navigate with respect to the calculation, and understand that, yes, you might see this surged total replacement costs of tens of millions potentially, but all of that can come over time to fund as those replacements are needed, not all upfront. So that concept of fully funded, it's more trying to align yourselves with the funds need to be available when it's expected that those repairs are going to happen.
Yeah, there's a lot of confusion with that fully funded because there's two concepts. It's fully funding all reserves. Like, what do you need? What future costs do you need to have in the bank? And when you read these studies, they talk about that fully funded number. But then we also say fully funded reserves. And they're like, what does that mean? So fully funded in the context of your budget means that we are putting in your budget the reserve contribution per the study, basically. That's what fully funded reserves mean for a year within your budget.
Amazing. I got a question here. Does an HOA also require a split between structural and non-structural reserves?
What was the question? I'm sorry, I didn't.
Does an HOA also require a split between structural and non-structural in reserves?
No.
So if you're an HOA, we keep saying 718, your Google will be 720. So that's the statute that HOAs will follow. And reserves at HOAs can only be established statutorily if they're voted on by the membership. So they're not required by 720, but if at one point your association all got together and said, you know, by vote and documented, we want to put away money to maintain the clubhouse, then those reserves would be statutorily enforced, but the concept of structural integrity is not in the 720 law.
Correct. And then go ahead. Go ahead,
No,
Roxanne.
HOAs can have what is called voluntary reserves. So that's the opposite, just in an HOA, not related to condos at all. HOAs can have statutory or voluntary. Of course, the best practice is always to have funds and have a reserve contribution every year, because HOAs do have assets, pretty large ones. There's a roof of a clubhouse, the clubhouse itself remodeling, the pool, some common areas, pavement. Sometimes HOAs are responsible for roads within their community, and that's usually a very big ticket item. So we always recommend, even though you're not required by statute to have HOAs, to think of it as a requirement every year.
Now, in an HOA, if you have a clubhouse or if you have any two-story condos, this does not apply, correct?
Yeah, I saw that question. I said, well, see, I would like them to check with their attorney.
Yeah.
Because I would have to ask, is your two-story condo on top of a parking garage? Because then that's where the attorney comes in. And the attorney has to opine and make sure that you're compliant with the statute. So I would consult with your attorney.
Same with clubhouses, right? If there's a third story in a clubhouse, it's the same thing, right? Well, two-story, third. If there's a clubhouse that has 3 stories.
Well, if it's an HOA,
No.
or are you talking about a condo? HOA?
No, if it's an HOA clubhouse.
No requirement.
No requirement. Okay, amazing. But check with your attorney.
And also, yeah, definitely. And this is residential only. So you may have
Right.
commercial condominiums that are 718. Those are not subject to the structural integrity reserve. So think about, I mean, unfortunately, this all comes on the back of the Champlain Tower. So think this is what this law is intended to prevent. So this was, but yeah, Roxana's, I always point to the attorneys. They're the ones that are going to interpret the law and actually put it against your association. Every association's got its own nuance. So I always point to that expertise as well.
It's great. Can you, Daniel has a question out here. Can you use pool reserves for the SERS component?
Yes.
Yep.
Yes.
Yeah.
So
What I will
Go ahead.
Go ahead.
So what I will say, the pooling of reserves is allowed. So with that, let's take a step back, right? You can do 2 methods of funding: straight line or component, what it's called, where each component, as we said before, would have its own reserve balance you're putting away. So the roof, the plumbing, the electrical, the waterproofing and painting, those would each have its own line, and those are reserves that are set aside for those specific components and can only be used on those components. The statute allows for what's called pooling, where the entire pool is comprised of all those components, and each component has a useful life and expected time for a expenditure to occur. So you're putting money into a secure pool for which they can be used on any of those components at those times, or at any time, really. But the calculation is that the pool should never go below $0. So these reserve experts will provide a calculation given the age and anticipated expenditure. What is the dollar amount that we're going to put away each year such that you will always have funds available for the anticipated expenditures over those years? But I would caution when you do set up a pool, or if you do set up a pool, to be sure that it is structural integrity reserve items only. That's the biggest thing we'll find is they cannot be combined with the other components, or else it taints the purpose of that pool.
Yeah, that's a great point. I think that was a big realization, at least from us, from a management company, that we need to make that distinction. So we gathered our troops in accounting to drive that home, that we definitely need two different lines for the pooled reserves structural, and pooled reserves non-structural. It can be combined for investment purposes. You could have one bank account, but as long as on your liability side, you're able to define how much money has gone into pooled versus pooled structural versus pooled reserves non-structural. There's a question of what do we do with interest? Because that's also like if you have one bank account and everything's going in there, what do you do with interest? So then there's different ways of allocating between the pooled structural and non-pooled structural.
Well, I'm going to get to that very soon because I'm very, very interested to see, take a poll out there of if your reserves are being funded. So I'm going to get to that question very soon, that poll. What percentage are you seeing out there of HOAs pool instead of straight line? There's a question out there that John is asking.
Me, 99% pool.
99% pool.
Yes, I'm thinking of one association that has not gone to pooling, and it's an association has a lot of sub-associations, etc., and they didn't go to the pooling method, but 99% of our associations are in the pooling method.
Gabe, what do you see?
We see the same thing. The only time, I would say I see straight line more on the HOA side, because on the voluntary reserves, they can specifically identify maybe the clubhouse as that only element with the clubhouse roof. Maybe the pool has a little something in the landscaping, but as far as condos are concerned, it's definitely above 90% pooled.
Is there a benefit of having it pooled over straight line? What is the best practice out there? I'm going to start with you, Gabe.
So the benefits, as we spoke earlier, once you put reserve funds in a roof component line item, those funds will sit there until the roof needs to be fixed. So think of straight line as these are specifically designated to these line items for when you need them. With a pool, so long as those items are identified within the pool and you need to, let's say, accelerate a repair, you're able to draw on that pool of funds for those components. So there is advantage to the flexibility of use. However, the caveat is with the pool, it requires a little bit more maintenance, in the sense that once you do, let's say, use a large sum of funds for the elevators that wasn't planned, you're technically taking a little bit from what should have been from the roof, the plumbing, the painting. So as I stated before, when a large project is done or conducted, a big repair, get that updated study to be sure that that large draw from the pool to fix some component didn't affect the funding plan that needs to be followed now.
Great explanation. Roxana?
No, just there's more restriction with the straight line. When you need excess funds over what you've put away for the roof, for example, then you're in a bind. Where do you get the funds? Because you cannot take it from any other component in a straight line. So then you're faced with special assessments, line of credit, then you start having to find the other funds, versus the pooled reserve contributions. They're available for the components. Let's make sure that we establish that they're there for the components, whether they're structural components or non-structural components. That's the only way that those funds can be used. But you have a little bit of flexibility to what we were talking about earlier. The studies are full of assumptions. So sometimes you do need those funds earlier than anticipated, and you need to just be aware of that, and it changes the calculation in the future, but you can make the boards have that flexibility of using those funds. They're there for any one of those components. So, you know, I like the pooling method from my perspective. I always recommend it if they're on a, you know, straight line, because of the restriction that boards have when it's under straight line.
And the beauty of the study is that study is not just a 1-year calculation. The reserve specialist is giving you a projection of 20, 30 years of that usage of funds. So pretty quickly, if you're utilizing that study, you'll notice that you're out of step. For example, if they felt at the end of 2025, you were to have 3 million sitting in your reserve fund, and you did a large elevator modernization project, and you're looking at the balance now here in September, and you're only at 2.5, knowing that that money is not coming in, that should raise a flag for you. Oh, we must have done something that the reserve specialist didn't account for or wasn't aware of. So now, do we need to update? So it's always a nice check to see where you're at and where the reserve specialist thought you were going to be at, and make sure that those are aligned, because that's a pretty quick jump to an issue. And then something else you said, Roxana, which is the question I always get, and you probably always get, is, can I spend my reserves on X? And that is going to be like, that reserve study is really your guideline, right? That reserve specialist was on site and has pictures and has identified every single component that they're putting away money for, or recommending that you put away money for. So that guidance is the reserve study. You know, one, of course, I could say go to legal, but two, the board is aware in that reserve study what these funds were specifically put away for. So that's the first place I always tell, you know, my boards when they ask, can we spend on X, Y, Z? So that was just something that when you have a pool of funds, you know, sometimes, you know, we get bright eyes and bushy tails when we can spend on anything, but be sure that there is some guidance there.
Yeah, Gabe, John had a question here. Is there a way to restrain an HOA board from misusing pooled funds? So, you know, when they see pooled, they can just grab from it. What are we doing to stop that from happening?
Well, I mean, I would caution John saying HOA is already thinks, are these statutory or not? Because when you're in an HOA 720 and they haven't been put away per statute, the membership has not voted on those reserves, you really have an argument to say that those are usable at the board's discretion. You've voluntarily set aside some funds for these items or types of items, but really there's no enforceability by statute to say that those were designated.
Yeah, and I think,
right, go ahead.
I'm sorry, go ahead. No, and I think with those scenarios, we ask our boards, let's pass a policy, right? Like a board resolution that we vow to abide by the reserves, even though they're not statutory, that there would be some form of approval process, at least some mindful, you know, approval process among the board, that there needs to be at least a majority that approves something to be taken out of the reserves that are not reserve component for the HOAs that have voluntary reserves. So I think that's where, you know, there would be some mindful and documented information as to when reserve funds are used for non-reserve components. So I think that may be a way.
James had a great question here. Can straight line be changed to pooling? What's the requirement?
You just have, go ahead, Roxanne. You nailed this one with me earlier.
Yes, the board has the right to choose the method that will be used to calculate reserve contributions for the following year. So you can change straight line to pooling simply by a board vote to do so. And that's pretty much it. You do not need a membership vote. However, that association has existing straight line components. So that association has been funding on a straight line and has roof at 100,000, painting at 20,000. Those cannot be put into the pool of funds until there's a membership vote. So it's forward looking. So the way the statute looks at this is that the board has a business decision. If you want to use the pooling method, you can do that for your association, and the board can make that decision. But all those funds that were restricted by components, by the component method, which is the straight line method, the only way to put it into the pool of funds is by a membership vote. So what happens with those associations is that we do start putting funds away in a pooled reserve line item, and we keep, unless they got the membership vote, but if they didn't, we still keep roof separate and pool separate or paint separate, depending on what components they had before. And when the roof comes up for renewal, we use those straight lined funds first before we go into the pooled reserve funds. So there are ways to do it, but the board can make that decision to change the type of calculation method.
Gabe, what have you seen on your end? Has this happened a lot?
Yeah, that's exactly right. Yeah, what we see is we do a lot of associations that turn over from developers. And for some reason or another, developers like to use straight line. There's specific elements that are there, they set them up. And then when they turn over, the board gets the formal reserve study and they want to pool. And it's exactly what Roxanne is saying. I always say that's prospective. Everything the board does is from their year forward. You can't go back and change it until or unless you get that membership vote to move those reserves. And you know, this question kind of jumps us into this category of these reserve specialists that are now doing these studies. They want to alleviate, let's say, the financial pain for an association. So a lot of questions, and I'm seeing one here, is this beginning balance of SERS. How do you establish that day one value for SERS? And we've been putting away money all the time, Gabe. What does that mean to me? And you know, this is honestly where I do say you need an attorney in the room. They need to tell you how you're going to establish or move that initial SERS pool. But what that reserve specialist will say is, you know, of your existing reserves, it looks like you've been reserving for component A, B, and C, which are SERS items, and D and E are not. So we're going to go ahead and split what you've already done between these two pools now, and we're going to start going with SERS and non-SERS from that date. Now, I won't touch that one. That's a legal question of, you know, what vote is required. You have to go to your docs, do that exercise. But if it's documented, that beginning balance is now your prospective pool starting balance, and that's going to be critical for your calculation going forward.
Yeah.
And Terry, go ahead, Roxana. Sorry.
No, I just want to add, that's one of our recommendations, another reason why we want that study. And we want to point to the study to make sure that it's all commemorated, what assumptions were made to make that split. Because I've gone to reserve study specialists, the first few that we started getting, we're like, but why, how are they splitting this? I mean, from just a logical point, I thought it would be a weighted average based on the replacement cost. And it wasn't in some. So then I needed to ask, like, how are you coming up with this number, that split, that first year where we're splitting between structural and non-structural? And there were a lot of comments. There's a lot of factors that some specialists use. And as long as it's documented, it's in the study, it's part of it, and you're consulting with the attorney, it's commemorated all in your study. So that we could always point to it. That's where it started. That's the split that was agreed to. And it's in compliance with the statute.
Excellent. Thank you, Roxana. You know, Terry and a couple other attendees here are asking, do SERS and non-SERS reserves need to be separated into separate bank accounts, or could it all be in the same bank account?
Same bank account. It's okay for investment purposes. So there is a piece of the statute that, I'm not an attorney, but there is a piece of the statute that says that for investment purposes, you could actually commingle funds. And funds in the fund accounting world, which is special assessments, reserves, and operating. You could actually put them all in one fund just for investment purposes, but you always have to keep track what money belongs to what fund. So in the case of reserves, yes, you could have it all in one bank account. And as long as you know in that bank account, there's two components. There's the structural and non-structural. And we always need to know those balances.
Great.
And I come from compliance world. So I say the better transparency that you can give your unit owners, that's best practice. The statute is silent to the requirement of a bank account. However, if you are to set up those two cash accounts, it's very clear to unit owners, to management, to the board, how much has been set aside. It can align with what Roxanne is saying, this concept of this liability, right? We told you we were going to put away 3 million, and here's the bank account that holds it. And then I want to wrap one concept around the interest portion, because I know we're going to get there. Any interest that's earned in that reserve fund stays there. So that the statute's pretty clear about that. Although you might be using that cash, in investment vehicles, and your reserve specialist may be accounting for that interest earned, that interest is to stay and only be utilized for items within the reserve fund. So I think that's a good jumping off point to the questions that were submitted. But I guess for that purpose, the cash purpose, more separation, more disclosure, more transparency. In my world, the better.
Thanks, Gabe. Yeah, I know that our treasurer, we're always making recommendations of where your reserves are, and we're trying to get the biggest bang for your buck in return on investment to help, the associations with their financials. Actually, a good question to ask now. Let's take a poll. Are your reserve funds being invested? I'd like to hear what everyone is doing with their reserve funds. And while we wait for the results, Roxana, Gabe, what are you seeing out there? Interest rates, or I think I had a question here with Ron had a question. Does the law still require that reserve funds can only be invested in like money markets, CDs? Is there a new law? Are there other options? What are you seeing out there? And that's quite a few individuals are asking the same questions here.
Yeah, as of July 1st, there was information that was stated in the statute. And I think it's because they realize, right, that now all this, at least condominiums are going to have a large pool of funds. And what are we doing with those funds? So they came out to clarify that there is a fiduciary responsibility on the board. Could even be a personal one. I'll have a story for that, and I'll share with you in a second. But basically coming out and saying that FDIC products are what they would recommend for investment purposes. They didn't specify other things like U.S. Treasuries. I think that was, a lot of commentary related to that statement that they made, because the simple fact is that you always have to protect those funds. Whatever we've gathered from your owners and they're there, they must be protected. Now, if you make some interest now, the rates are nice. We're getting rates between 3.6 to 3.85% on our funds. So it's very nice. You're, on $1 million, it does make a big difference and impact. And so we're just cautious as a management company. We only recommend FDIC products. There's many out there that are still, earning in that range of interest. But there's been the occasion where, at least one example where there was an owner that recommended to the board to come on with them as an investment banker, and they invested the funds in the stocks. We weren't aware of it. It was a bit of a trust factor between the board, and this has been many years, but it did happen. And we became aware of it when we were doing the financials. And at that moment in time, of course, that is not a vehicle that is susceptible because it's prone to volatility of the market. It goes up and down, and we can't do that to owner funds. At that moment, they had to sell immediately, and they lost money, and each board member was liable for those funds that were lost. It wasn't a lot, but it did happen. I actually went through that experience once. So what we recommend always is that they are invested in FDIC products. And as a company from all your banks, the banks that we deal with, they send us reports of any association that may have excess funds that are not covered by an FDIC product. So we even go to that end. We make sure that our clients' funds are under FDIC protection.
That's amazing. Gabe, hold that thought. So 68%, yes, are being invested, the reserve funds, 50, which I would love to see that at 100%. And 15% said no, and 18% are unsure. So those are interesting numbers. We need to get that 68% higher.
Yeah, and what we see out there is, I mean, the statute came out with some language that says, the investments must prioritize safety and liquidity. So from our standpoint, checkbox number 1 is FDIC insured, do not have any exposed funds over the 250,000 per depositor, right? So you're going to want to check with your banking relationship to be sure that there's insurance programs, right? There's sweep accounts, there's CDs, there's, they've got it all. So your banking relationships will be able to advise on securing those funds. And then what I'd say is the products that are typically invested in are those same boring. You shouldn't be in the crypto. You're not trying to fund your reserves overnight with some moonshot investment. They are going to be your boring, secure CDs, money market funds. That's what we're seeing in the industry. I guess no. I mean that's basically it. I mean protection first, and then safety second. I think that's where we land with most of this.
Great. There's a question here for both of you. If your reserves are invested in earning interest, do you use some of that to pay federal taxes that may be allocated to your reserve interest?
You go first, Gabe. We've had conversations about this.
Yeah. So what I will say is let's first of all, this is a almost foreign concept to this industry, right? When's the last time condominiums were even subject to taxation, right? Most of the boards that I get will pick up the phone and say, hey, we're not taxable, and it's because, interest rates have never been this high with this many funds, this much funds sitting in reserves. So I guess the short answer is yes, interest income is taxable. Such that it exceeds allocated expenditures, similar to as your personal, when your income exceeds your expenses, you may generate some tax. So that's the first thing I would check, right? So if you are earning substantial interest, I say pick up the phone, call your CPA just to see if there's income tax that's going to be paid or charged. The other thing is, interest income is actually something that reserve specialists are modeling into their reserve balances. So they are asking, hey, how much cash do you have in your bank account? And can we apply this to the aggregating reserves? And if you take a look, some of them are netting income tax on that. They're not applying 100%. So inside those reserve studies, sometimes you'll even see that those specialists are picking up on the fact that they might not get that gross amount to the bottom line, probably because of this income tax effect. So can income tax be paid from reserves? I think that's a per CPA choice. That's going to be, you're going to have to talk to your specialist to see how that's going to be maintained or how it's going to be paid. And just having the professionals in the room to consult on that on a case-by-case basis.
Thanks, Gabe. And Roxana, before you go in there, I want to ask a question to take a poll to all the associations out there. Are you invested in all FDIC insured backings? Because I'm interested to see where they're investing here. And while you're speaking, Roxana, we'll give them 30 seconds here to answer. I'd be interested to see who is investing in FDIC insured backings.
Yeah.
Because go ahead.
No, to the question before about whether or not paying those taxes borne by the fact that associations are lucky enough gaining more interest. And typically it is the reserve funds that generate the greater interest income. So we do get the tax accountant on the phone with the client and we walk through that. I have gotten opinions to pay out of reserves. So
Okay, great.
that has been signed off by the attorney and the board and, the CPA.
All right, let's see here.
Great.
So 69% yes, are FDIC insured. 17% no, and 14% unsure. So for the unsure, you may want to look into that. For the no, highly recommend to make sure you're FDIC insured. We've had a couple experience the last couple of years, and you've seen what's happened in the financial industry. I know we're running out of time here, and I want to give each of you just 30 seconds. Best practices, what you should be doing. What do you recommend? Just give me what your final thoughts.
For me, start early. Budget season is in full force for us. We're already doing budget workshops, so starting early. If you haven't started, please start. There's a lot of things because you need a lot of people now. You need your accountant, you need your attorney, and the specialist, that reserve specialist. We need to consult with these professionals. Best practice is to look at your professional fee expense line, increase that. That's been our recommendation for the last 3 years, in light of the fact that we are relying more on those attorneys and reserve specialists. And don't lose sight of the budget. I think not only starting early, but always trying to project to the end of the year helps, and having those variances monthly will help you in the budget process.
Thank you. Gabe?
No, I was going to say that the name of the webinar was very fitting. Advanced strategies. And advanced, I'm not saying anything that's out there, new tools or concepts or technologies. What I'm saying is have that long-term advanced planning, just to Roxana's point. As a board member, as a treasurer, as a manager, you need to be in it. I mean, you're giving your time to be sure that you're carrying out your fiduciary responsibility. Best practice is to make sure that you're utilizing all your specialists, all the information you've gathered to be sure that everything's in line. Keeping a constant monitoring, utilizing that reserve study, picking up the phone and calling those people that know the industry. I know we pride ourselves on having people call us, any time during the year, just to save us some time on the back end. So what I would say is always be forward looking, utilize your specialists, your management companies, and be sure that you're involved in the practice early, so you're not correcting problems down the road.
Thank you, Gabe. Great advice. It was truly a pleasure having you both on the panel here. Thank you very much. Everyone be on the lookout for our next communication, for our next webinar next month. I wish you the best. Stay dry. There's some storms out there. Okay. Everyone, have a wonderful day.
Thank you.
Take care.
Bye.
Bye-bye.
Thank you all.